Portfolio Builder members, welcome to our October 30th trade alert. Today we have the big Fed announcement, and I hope everyone is staying warm out there. Let's see who we have live today. If you're live with us or joining in, make sure to say hi. So what's the big news? SPY is set to soar. GDP remains strong. Sure, it's slowing, but 1.9 is not too shabby considering the trade tensions and tariffs that are holding back the economy. But this is forcing all the central banks around the world to become dovish. So let's take a look at the results of this week's trade alerts and then jump into the topical news. At 2:30 Eastern, we'll have the Fed press conference with Jerome Powell with the forward guidance, which will be the most important, unless he disappoints the market without dropping rates by what we expect to be 25 basis points. Okay, so let's review the trade alert from last Monday through today and how our total portfolio has performed. The SPY went from 303.21 to 302.78. That's a 43-cent loss. Meanwhile, our option caller brought in a credit of 9 cents, and when we closed out the position today, an additional credit of 23 cents. So this offset the pullback in the SPY by nearly 75%. We only lost 11 cents a share. And what's important is the rest of the portfolio did its job. So the TLT position, which month over month is down 3%, bounced back slightly. I do suspect it will travel higher in the coming weeks. And we remain long both the SPY and TLT as our core position, but we have begun to tighten the collar on the SPY as it's at near record highs. The TLT position, which in our portfolio is just a tad bit over the 2-to-1 ratio, just worked out to fill up the total portfolio. In our slide, you will note that we do have a 2-to-1 ratio exactly. So TLT is up $1.30 per share from Monday through today. GDX, the gold miner ETF, is flat. And emerging markets from yesterday to today did drop 30 cents. It was up the previous day on 3,800 shares. So the net result is a $3,483 profit in our portfolio. And the breakdown is we lost 187 on the SPY, picked up 4,810 on the TLT, flat on GDX, and emerging markets, if you do just look from last night through today, down $1,140. And this is after it was up from Monday through Tuesday. So that explains why our portfolio remains flat at a negative 0.4% return in October so far, which is not too shabby. We'll look at our returns and how we've performed over the past 11 months and why we're very happy and proud of our track record thus far. The key news that we highlighted, and I'll be looking at slideshows in a minute to get into details of this. Multiple central banks expected to either lower interest rates or remain at low rates today. Bank of Canada, for example, came in with no policy change today. U.S. GDP came in strong, beating expectations with 1.9. And all eyes will be on the Fed Chairman Powell press conference for hints at forward guidance coming up at 12:30 my time or 2:30 Eastern. Meanwhile, trade talks are already starting to show signs of delays, and we get earnings from Apple and Facebook after the bell today. Here's our current recommendation for asset allocation. 100 shares of the SPY. We trade Monday, Wednesday, Friday at noon Eastern. And again, we will never touch these positions outside of the trading time. This makes the program extremely easy to follow and to get the same results as our model portfolio. 200 shares of emerging markets on Tuesday, 200 shares of TLT, that's the long end of the Treasury market on Thursday, and then we currently have a buy and hold on GDX of 250 shares. This gives your asset allocation 50% on equities, 40% in bonds, and 10% in gold. Now, if we look at our returns, you're going to notice that the goal of our program is safety and income for retirement. We're not your young folks trade alert advisor who's trying to pick up big gains and outperform the market. In fact, you're paying us to underperform the market and take the volatility out of all these different asset classes. And I'd say we've done a damn good job December, the market flew down 20% from peak to trough. We pulled in a 1% profit. January, the market completely reversed course. Who would have guessed? Our portfolio did not take a hit, which is unusual to generate a profit in such a dramatic change in direction. We pulled a 2.2% return in January. Underperformed the SPY, but once again, we're not trying to outperform the SPY. February 1.7, March 2.7, April 1.2, May, surprise, people took a bunch of profits. The market collapsed 7%, giving you a second headache in 2 quarters, just from December through May, and we pulled a 2.2% profit. In June, the market flew up some 8.5%. We underperformed with a 3.2% gain. And then the evil July, this is when we had the trade talks in Osaka. I was positioning our portfolio to protect against a dramatic sell-off in equities if the trade war had escalated. Well, it didn't. They said they're going to make, you got it, a farm deal. We lost 1%, not a big deal. Preservation of capital is the core concern. In August, we were completely sideswept. I thought he was going to completely push the tariffs down the road, kick the can down the road to after the election. And sure enough, come August, he threatens to raise tariffs in October and December. The market sells off another 7%. Keeping up this market crash every 3 quarters cannot be fun to live in if you're all in equities. Well, our strategy, because we have put options below the SPY, the put option kicked in, limiting losses on the SPY, and the TLT flew up in value. And so that's how the strategy works, 1.8% return in August. Now, if you look at September, S&P 500 flew up 5% and then flew back down 5%. So it went nowhere. We outperformed the SPY during this period with a 0.3% return. And once again in October, we had another critical trade talk. And once again, we positioned our portfolio for more bad news. Much rather be precautious, be Debbie the Downer. And in this case, we were wrong. The market came up with a phase 1 deal and celebrated with a market rally to new highs. And that brings us to our current return, where we're down 0.4%, although I suspect this will work its way back up. Now, we didn't manage to get to a profit in October as we're near the end of the month, but I do suspect we can generate some consistent returns in November and December with the same strategy. So we'll look at our general strategy currently, but let's take a look at the most recent trade alert. Here's what came to you in your text message. Buy to close the October 30th 304 SPY call and sell to close, and this was fixed in the trade alert. I'll fix it right now. The October 30th 302 put. So we've been tightening that option collar. If you join our webinar tomorrow, if you're a freebie, I'll teach you all about how we use options to generate income from these 2 assets. And if you're a paid member, we have our paid member webinar coming up in 2 hours, just a little bit under that. The second part of the trade alert was to sell to open the November 1st, 2019 304 call and to buy to open the November 1st 302 SPY put. So even though we're expecting a rally in equities because of the dovish Fed today, there's just so much that can go wrong. We're not going to be greedy. We're going to continue to have tight option collars at these record high prices in the S&P 500. Now the TLT I am leaving relatively loose as I think it will travel higher, and I don't want to miss out on some substantial gains in that portion of our portfolio after having to digest a 3% drawdown in 40% of our portfolio. So with that surprise sell-off in the TLT, we still are barely down this month, so everything's going just as planned, and we've been able to once again protect our capital. Here's how you close out that trade: buy to close, sell to close. We pulled in a credit of 23 cents. Here's how you enter the new trade: sell to open the 304 call, and then buy to open the 302 put. All this means is we will forbid any profits above 304 because we're agreeing to sell our shares at that price to the option buyer. But we will get to keep his 77 cents he paid for the right to buy that option contract. So we have upside potential of around 77 cents from the option contract, plus an additional $1.22 because the last trading price was at 302.78, and we'd be forced to sell at 304. So if we go up that high, wonderful, we'll generate a nice profit on the SPY. On the other hand, if something goes wrong, say the Fed does not cut rates, says everything's hunky-dory, China continues to backpedal on the trade deal like they've done for the past 2 years, Apple has some bad earnings slip after the bell today. There's a number of things. Impeachment fears coming in now. There's just so many risks in the market. We have a 302 put, so no matter how low the SPY goes between now and Friday, we get $302 per share of SPY because we bought that insurance. And what's neat is if the market does travel lower, that call option we sold will turn into nearly 100% profit. So we financed downside protection nearly for free, but we do not miss out on upside potential. So here's our risk graph. We potentially can make $96 per contract. And if you think about that, if you can make $100 3 times a week, 52 weeks a year, that's a huge return. That's almost $15,000 a year of income just by generating that return. Now, we're obviously not trying to hit that target. We're only trying to average around 25 cents a share on the SPY over the long run to achieve a 1% return. Now, we've been outperforming that by around 50% with an average return per month of 1.5. Okay, so that's the general strategy. We have a tight option collar on the SPY and a relatively open option collar on the TLT. And this gives us the courage to try to ride the SPY up to where I believe it can travel to if this positive narrative on the trade deal remains. And I believe that it will be in the 315 to 330 range. And so the big catalyst that will really drive it into that price will be a phase 1 trade deal being signed. So here's a look at your SPY ETF over the past 10 years. And you can see it's been a heck of a ride. And I think it still has a little steam in it before we get the next big market crash. Perhaps 1 to 2 more years. And we'll take a look at what's going to ruin the party eventually. TLT has been a wonderful ride towards all-time highs just a few weeks ago. It's down about 3% for us in October, but I don't believe the party is over for TLT. The key thing to study for the TLT is just to follow what the central banks are doing. Are they in a phase of lowering interest rates? Or are they in a phase of pausing or raising interest rates? And right now, CPI continues to come in low, and the growth figures domestically in the U.S. and globally are slowing down. So that's going to push them to drag their feet but drop rates slowly and surely. So my expectation is the TLT has not yet hit its all-time high, that we're going to see a consistent drop in rates, probably delayed every 3 to 6 months until they finally get a real recovery, if they can get a recovery. Now, China's got a whole host of problems, and depending on when they decide to fix those, I think we'll see the big recession hit worldwide. Emerging markets is our Tuesday play to get back to the 2017 high, which would mean China is going to kick the can in terms of trying to fix its debt binges and problems and will expand its credit and lower interest rates. It's been lowering interest rates. Now we're just waiting for it to inject a lot of money into its economy. But this trade deal would be the catalyst that can take emerging markets back to that 2017 high, which would send us up another 20% from here. Now, on the same note, I do recognize China is extremely over-leveraged and due for some massive fixing up of its debt. So whenever that does occur, we can flip our option trade to profit from emerging markets crashing. So if we see the phase 1 trade deal continue to have trouble, expect us to use the inverted option collar. The basic strategy is we still own these same assets. We sell the call option to finance a put option. But if we go to in-the-money call options and in-the-money put options, we can actually have a beautiful setup to profit from a down move in these different assets. So again, we're hinged on a phase one trade deal for the short-term moves in the equities market. But in the same time, our position in the bond market and gold market is relatively secure because there's very little risk that these central banks are going to actually start tightening monetary policy anytime soon, especially in an election year. That'd be highly political, and I don't think that will happen. Meanwhile, here's our look at the gold miners. This is probably the most important exchange rate in the currency markets, even though the yuan, the Chinese currency, the yuan, only represents around 1% of total trade volume in the currency market. This is their mechanism for offsetting tariffs. So in our boot camp program, we've been dying, which starts up next week, we've been dying to short the Chinese currency. However, this phase one trade deal is supposedly going to get an agreement that the Chinese will maintain a stable exchange rate and stop devaluing their currency to offset penalties America imposes on the Chinese for any violations in IP theft and a whole other host of complaints the U.S. has against China in terms of trade. So again, most likely none of these deals will really happen. And if so, they'll probably be short-term deals just to relieve both parties for a small amount of time. And like I said, I think the only realistic deal we can really count on will be some agricultural purchases for a delay in tariffs and maybe some easing on Huawei. So we'll see if that comes to fruition in the next 2 weeks when they're expected to potentially sign some sort of deal. I would not be surprised if it's delayed and causes some run-ups in gold and TLT. But if they do stick to their narrative, then we don't want to be short stocks. So it's an interesting setup. That's why we have the tight option collar on the SPY. Any hiccups that come up in the trade deal or the Fed policy would most likely cause a sharp sell-off in equities. Now, I'm not looking for a big long-term crash yet, and we'll take a look at what would have to happen for me to be bearish for more than just a few weeks on the equities front. Here's a look at the German 30-year bond. This has been the best leading indicator for U.S. Treasury rates. And you can see the big picture. It's been crashing because of China's slowdown. Can't trust China, but we can trust German numbers. And so interesting, for the first time in quite a while this year, their 30-year popped up over zero. So it's actually a positive yield instead of a negative yield, which makes absolutely no sense to have negative yielding bonds. Why would you buy a bond that's guaranteed to lose you money every year, and except unless you're trying to flip it to their central bank for a profit and hedge a big equity portfolio, which is what everyone's doing, buying all these negative yielding bonds. Here's a look at the yield of the German bond over the past month. And again, I do think this is a very short-term rally, as there is most likely more trouble ahead in the global economy and the U.S.-China trade relations. Now, can we get a breather and a phase one trade deal? Sure. But will they really do anything with phase two and phase three? This is going to get very, very interesting leading up to the election. We're running out of time to create some sort of deal, and any more pressure could dramatically put equity markets in a tailspin. Here's our 30-year U.S. Treasury. You can see the similarity between the German bond also having a short-term rally. But once again, I think there will be some hiccups coming our way to drive these yields lower. Dollar index remains strong no matter what the U.S. does. We've cut rates twice. This will be the third time today, if everyone's expectations are correct. We've now injected $200 billion into the balance sheet of the Treasury, which is not a lot when you compare the trillions of dollars that are in their balance sheet. But I'm expecting over the next several months they will have to expand it by at least another $500 billion to support two core banks. We now know primarily who the big repo madness people are, and it's Goldman Sachs and JP Morgan. Go figure. As long as this remains at a high level, it does indicate weakness around the world and will further push the U.S. to keep lowering rates, trying to take some pressure off of our exports. And meanwhile, we don't just have 10% in gold. We've actually done 8% in GDX, 1% in Bitcoin, 1% in Ethereum. To be long these assets, it's a very particular set of circumstances. Again, these assets, gold, Bitcoin, Ethereum, they don't generate income. They don't have profits. People buy them because of reckless monetary policy. So luckily, right now at this point in time, and this was not the case in 2018. In fact, it was the opposite. We have, number one, lowering interest rates. Number two, we have the central bank payoff. Now, what would we look for to be long-term bears in equities? We're going to need to see a crash in the credit market. So I'm highly focused on two ETFs that give you a very broad look at the health of the credit market. So LQD is your investment grade bond fund. That's like your Microsoft, your GE, of all things are in there, AT&T. Between GE and AT&T, these are two of the biggest bond issuers of all time in U.S. history and represent a huge chunk of this ETF. But the higher it is means the lower the interest rates for corporate bond debt. And what are the corporations doing with all this bond issuance? They are buying their own stock back. So until this circle loop is broken, how on earth are you going to get a long-term crash in stocks? So that, alongside with the U.S. being able to borrow at low rates and create record deficits, continues to push strong GDP numbers. Now, sure, if you go borrow money and then go spend it, your GDP is going to look good. So we all know this won't end well. But in terms of playing the markets, we got to realize we're in a big bubble. The central banks and the politicians do not want to do the right thing. They don't want to jack up rates to probably around 5 to 6%, get all the misallocated capital out of the market, get all these zombie tech companies who are losing billions of dollars out of the way, build real businesses that actually do good for humanity. Nope, that's not what we're doing. We're printing money and feeding all these debt-hungry companies who don't actually use the money to increase the labor or anything useful. They're just buying back their own stock. Okay, so here's a look at the GDP, strong GDP print today. Sure, we're slowing down a little bit, but this is very strong and a level that can probably be maintained and continue to expand the debt and not blow out our debt payments. Here's from China's communist little Twitter handle. 1.9%, that's less than 1/3 of China's 6% growth rate for Q3. This is the sign the U.S. economy is doing great. MAGA is almost a blank in U.S. economic field. Those who disagree, please tell me what historic projects the U.S. has built in these 3 years. Okay, so China's had a huge GDP crash from 30%, I think about a decade ago, to 14% 5 years ago, to the lowest print in 27 years, 6% this quarter. And so this is very troublesome. They've been able to maintain a strong GDP by doing massive build-out projects, building cities that no one lives in, building trains that no one rides on, building airports that no one flies through, and now they want to do this Belt and Road project. So if they continue to be able to print money and borrow through the world, they can keep doing this for quite some time until inflation comes in and forces everyone to start reducing the monetary supply and raising rates. Now, on the other hand, if the U.S. does apply more and more pressure on China, it's almost certain to crack China's debt bubble sooner than expected. So it's very, very important to watch the narrative between U.S.-China, whether it's becoming more and more aggravated or if they seem to be having a period of peace. Now, go back to the Cold War. Lasted 3 decades. There were periods of peace and there's periods of escalation. So for us to do a good job with our portfolio, we have to be able to recognize which kind of period we're in and adjust. Goldman Sachs, the Q3 GDP report provides additional evidence that growth has slowed but likely remains close to potential. And this is funny. For some reason, Americans are spending a lot of money on RVs. $46 billion, or 20% of all personal spending growth, was from RVs for the second quarter in a row. U.S. administrative official, phase one of the U.S.-China trade deal may not be signed at Chile APEC summit, which just got canceled. We don't know why, but now China has offered to meet up in Macau, and so we'll see if they really meet up and do a phase one trade deal. Vice Pence did a pretty critical speech of China, especially of their work camps. And so they are not so happy about being critiqued in any way, shape, or form, as we've seen. Bank of America corporate buybacks decelerated slightly despite a busy earnings week, but the cumulative year-to-date growth rate remains strong at 26% year over year. Once again, until this corporate buyback mechanism breaks itself, it's going to be very hard to have a substantial pullback in stocks. Treasury Secretary says U.S. economy continues to be strong with low unemployment and low inflation. There's no question that global growth is slowing down. China Foreign Ministry says lead China-U.S. trade negotiators will speak again soon. Working level China-U.S. trade talks will continue at a fast pace in the meantime. And let's just throw out a quick hello to people in our chat. Ernest, hello, welcome. How's it in Utah? You getting any snow yet? Morning, Brian, John, Ron, Tom, Scott. We got quite a crowd today. And Victor, thanks for joining live. White House Ukraine expert says he tried to correct voice recognition transcript of Trump-Zelensky call. This is happening today. And apparently they're going to make these impeachment inquiry hearings public with 90-minute sessions for both the Democratic and Republican leaders to interview witnesses. Carefully watching this. Nancy Pelosi, we've learned so much about Trump's month-long campaign to pressure Ukraine because military veterans and his own national security aides stood up to tell the truth. They put their country ahead of everything else. It's not too late for Republicans in Congress to do the same. The House will vote on Thursday to move forward on open hearings as we set out the process for the next phase of our inquiry. Americans will get to hear about the president's abuse of power firsthand. I gather Republican leaders do not actually want that after all. Here's a chart of the banks who's started to refuse lending money overnight and caused the repo madness. JP Morgan and Goldman Sachs are the key GSIB surcharges. Paul Tudor Jones warns of a market collapse if Warren is elected, says, I love Mayor Pete Buttigieg. And I've got to tell you, I've been surprised with how well she's able to market her policies, not only on Twitter, but also in debates, town halls, and such. Beijing bars student activist leader Joshua Wong from district council race, so they're having more trouble in Hong Kong. And again, this is important because this is how China is able to gain access to capital from a world market through the Hong Kong exchange. Now, Hong Kong's GDP is crashing, the riots continue, and so this drama has not subsided yet. Meanwhile, Joe Biden, who is clearly supposed to be the Democratic nominee, and probably why this whole Ukraine scandal was brought to light in the first place, obviously, is potentially losing in Iowa, and his probability of winning continues to get tarnished week after week. So we'll see how that develops. I don't think the Democrats want Elizabeth Warren, as she is against a lot of powerful people who typically support the Democratic Party. Bank of Canada maintains benchmark overnight rate at 1.75, keeping rates low. Meanwhile, Huawei does tie into the trade deal. They went from a little company who is stealing products from Cisco to the world's largest phone seller in the world. And they're putting problems for Apple and for Samsung because they are developing phones and then selling them at a loss. So they're subsidizing this company from China's total government and making it very hard for us to compete. Now, it's really what's really comical is the CEO of Huawei and his daughter have photos going through airports, and they don't have a Huawei phone; they have an Apple phone, which is very funny. But what's more important is how this plays out in the trade talks. This is one of their biggest tech companies, and if we were to actually place all the sanctions, cut them off of the Android platform, cut them off from the processing chips, that's the one thing that China's not been able to do, is create the processing chips for these phones. So they still rely on U.S. and other companies for those products. I just pulled up I'm starting to track the CPIs of important countries to look for hints of inflation. So far we're seeing some food inflation in China, but not manufacturing or production inflation. Once we start to see inflation pick up, that is going to be the nail in the coffin for both the bond market and the stock market. Most likely we'll see bonds crash first, and as those yields jump up, money will then flow out of the risky stock market into high-yielding bonds. So that's what I suspect will happen if there's no trade tensions. We'll see more and more money printing, more and more stimulus, and as soon as inflation gets bad enough, the central banks pull the plug on QE, start to raise rates, and you get your bond crash. Now, on this other note, if we get trade tensions ramping up right now and impeachment fears, we may have the exact opposite. We might have a final flood of money into the bond market and get that stock crash first. So flip a coin, buy your put options on both, play it safe, and that's how we're doing it. Quick little note about what we do, and then I'll let you guys go. For our paid members, which are most of the people live right now, we have a webinar in about an hour and 20. I'm going to run it a little short today because I do want to be ready for Powell's speech at 2:30. So expect about a 30-minute presentation today where we'll do Q&A, look at our positions, compare the option callers on the TLT to the SPY. And here's just a little quick piece about our program for those of you listening and getting this delayed. Daily income trade alerts at noon Eastern. We've reviewed our returns, but again, we're not trying to outperform any other advisory, and we're certainly not trying to outperform the SPY. In fact, we're trying to tame it down for you. Our goal is to generate a consistent 1% return, and we've outperformed that considerably over the last 11 months. And our portfolio really stands out when the S&P 500 has a serious pullback, our put options kick in, and the TLT delivers very nice gains. You can see that clearly in December when the market flew 20% down. We made 1%. In May, flew down about 7%. We made 2.2. In August, it unexpectedly flew down another 8%. We made 1.8. Now the market has recovered each of these times, but what about when it doesn't? Are you really ready to continue hanging on to long equity positions through 5, 10, 20% volatility? Or would you rather have a smooth 1 to 2% return a month? And on a bad month, a very bad month, we've lost 1%. Here's a review of our trade allocation. If you have 75K, again, trade the SPY Monday, Wednesday, Friday at noon Eastern. Emerging markets, we only trade once a week, Tuesday. TLT, that's our bond portfolio, we trade on Thursday. And then we're buying and holding GDX. We're not trading GDX. We're not doing option callers on that. That's really our key position to generate a large return when panic hits the market. The bonds will do a good job, but gold will do a great job. Now, if you have a little bit smaller portfolio or you just like to work a little bit less, here's a setup that has the same 50, 40, 10 equities, bonds, gold, same target return. You'll probably get a little higher return if we're predicting the markets correctly in this portfolio because emerging markets is a more volatile asset and does have a potentially bigger upside. So 400 shares of emerging markets on Tuesday, 100 shares of TLT on Thursday, and then still a buy and hold on GDX. Our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement. Our goal is income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. If you're a non-member, we have a 40% discount deal today, and you can get that by calling Dean at 505-322-7515. He's an expert options trader, can answer all your questions about our program, and hook you up with that discount over the phone only. And if you're a member and you'd like to upgrade to a lifetime deal, stop paying that annual rate, call Dean, 505-322-7515. A reminder, we have our paid webinar at 2 Eastern today. It will be a little shorter than normal, so I can hop off and listen to the press conference. And meanwhile, Thursday is our freebie webinar, same time. Check your email 1 hour before for the access link. Let's see if we have any questions out there before I let you guys go. All right, gentlemen. Well, I appreciate serving you, and we'll have our TLT trade out tomorrow, and can't wait to see what the Fed has to say today. So thank you so much, and see you guys on the webinar in a few minutes.